A slew of recently reported new data confirms that strong growth is underway in the U.S. economy, and investor nervousness before the election gave way to optimism in the first 10 days that followed the surprise victory of President-elect Donald J. Trump. Stock prices had dropped for 9 consecutive days leading up to the election, as Mr. Trump overtaking Hillary Clinton initially unsettled investors. In the 10 days since, the S&P 500 rallied back to where it was before the election and then some. The optimism about Mr. Trump can be seen in the changes to the consensus forecast of economists surveyed before and after the election by the Wall Street Journal. In the first post-election survey of 57 economists, the consensus forecast for GDP growth for the next 3 years was revised modestly upward. That's good news. Optimism about Mr. Trump bolstering growth comes at a time of a Goldilocks economy. An economy that is neither too hot nor too cold makes the job of the U.S. Central Bank easier. Managing the U.S. economy is like steering a cruise ship. Federal Reserve Chair Janet Yellen is maneuvering the ship through tight spots and will undoubtedly encounter some turbulence along the way. Ms. Yellen, testifying on November 17th before the Joint Economic Committee, reiterated the Fed's accommodative stance on monetary policy for the long term. Reading between the lines about how the Fed expects the economy to evolve, Ms. Yellen is saying there will only be gradual hikes over the longer term. However, she is also saying that a near-term increase in the Fed fund rate may be necessary to prevent excessive risk-taking and keep the economy running on an even keel. A quarter-point hike in the Fed funds rate in December is widely expected, but the next rate hike after that could be months away. The last hike was about a year ago. Average hourly earnings have accelerated sharply since the end of 2013, while inflation has been dormant. The result is shown by that sharp move higher at the end of the line in this chart. Real purchasing power has surged since 2014, and lately it has been booming. Consumer spending accounts for 70% of growth in GDP, so this is really good news. Spurred by real wages, just released retail sales data through the end of October shows that consumers are on a spending spree. While the financial press and election coverage would lead you to believe the economy is a basket case, key metrics like this one show you the economy is booming. For example, retail sales excluding gasoline grew 4.5% over the past year through the end of October. That's almost 50% higher than the 3.1% growth rate in retail sales at the peak of the last economic expansion. That was a debt-financed period that led to the global financial crisis and the Great Recession. This economic expansion is not the result of a debt bubble. Interestingly, retail sales growth is occurring everywhere except the traditional retail sales outlets. Department store sales, according to the latest government data, plunged nearly 7% year over year through the end of October, while Internet retailers, dominated by Amazon, soared in the same period by 12.8%. Department stores are a shrinking retail sales format, while the volume of retail sales online is gangbusters. It is a stunning transformation in the economy. Housing starts have surged, according to data released on November 17th. While they had dropped in September, they roared back last month and are up 23% compared to just over a year earlier. With housing starts soaring, new single-family home sales have really grown by 30% from a year earlier. Housing is a key driver of U.S. GDP growth, and the picture there is bright. The other important statistic released this past week was weekly unemployment claims, which hit a low not seen since the 1970s. The unemployment rate is 4.9%, which is lower than it dropped before the last recession. The index of leading economic indicators for the U.S., a forward-looking measure of the economy, gained slightly in October. This index is a reliable predictor of a recession. It nosedives months in advance of a recession. So, moving up gradually, like it did in October, or even staying flat is good news. The Standard & Poor's 500 index is a fraction from its all-time high, reached on August 15, 2016. The bull market is old by historical standards, and this is already one of the longest economic expansions of the last century. Investors should be prepared for a drop in stock prices at any time, even though all of the key economic benchmarks are indicating the economy is running strong, and none of the signs that normally precede a recession are evident.